Everyone's wondering how a second Trump presidency might impact the housing market. But don't forget the media headlines and political drama. What really matters is how policy changes could affect your ability to buy or own a home. Will tax cuts put more money in your pocket for a down payment? Could deregulation make homes more affordable? Or will inflation and higher rates price you completely out of the market? Today, we're cutting through the noise to focus on what potential Trump policies could mean for housing affordability, your wages, your mortgage rate, and the prices of homes in your market. No partisan politics, just practical analysis of how proposed policies might impact your path to homeownership.
Absolutely, Jeb. Let's just jump in. What do we always talk about on the show? What are the things that impact you as a home buyer, homeowner, someone wanting to build wealth through real estate? It's affordability, and affordability counts on three factors. Your wages, so your income, your household income. So not just the income that you make, what you get to keep after taxes. Interest rates high, make payments higher and homes less affordable. And then home prices high, also less affordable. We talk about that comes down to supply and demand. Mm-hmm. So all of the things that were talked about during election season, we did an episode on, hey, Kamala wants to do this, Trump wants to do this. We have the certainty now that Donald Trump's going to be president for the next 4 years. And we have a Republican Senate, and it looks like at least a split Congress where they're going to be able to pass a lot of stuff. But we talked about earlier here today, Jeb, great. Politicians have ideas. They have things that they promise on the campaign trail. Then they get priorities when they get into office. Then those priorities hit the reality of what can get passed. And then does it do what was actually intended? So a lot of still unknowns in that, but we're going to go through what we believe Trump is going to attempt to do in relation to housing policy over the next 4 years and how that will impact you as a buyer. And most importantly, how it should impact your decision making in the short term.
So let's talk about income taxes to start with. We know based on his previous experience in the office that he wants lower taxes. He's a businessman. He wants growth in the business sector. Lowering taxes allows some of that to happen. And we've seen the market react to some of the policies that we're going to talk about today, and we can kind of throw that in. But let's start with taxes, Josh, because we have some things expiring here real soon with, the SALT taxes that were passed back in his originally when he was in office. So how does the tax piece of this puzzle impact the things that we mentioned earlier?
So income taxes and the fact that those are expiring here coming in 2026, and we're going to get relitigated here in the first 2 years of whoever's presidency, was probably the number one thing that had a potential for changing or impacting the way we look going forward. Most likely, we're looking at the status quo, right? He passed with a Republican Congress and a Republican Senate in 2016 or 2017, these tax cuts. That doesn't mean that they're going to go through exactly the way they were then. There will be some compromise. There will be some give and take. But for the most part, it's going to look really similar to the tax regime we've had for the last 8 years. The big difference there is there are many Republicans in high tax areas, high tax states, California, New Jersey. And even though they're part of that majority, they're against this state and local income tax cap. So let's spell it out for those of you who don't know what it is they take all of your state income taxes are a deduction against your federal tax bill or against your income for your federal tax bill. That includes property taxes. But after those 2017 tax cuts, it was capped at $10,000. So we use an example here. If you're in California, a fairly high tax state, you're easily paying 12, 13% of your household income towards state income tax. So if you make household income is $120,000 and you got 12%, we got $14,000 right there. So you are getting capped at $10,000. Well, if that same family owning making $120,000 buys a $500,000 house, that's another $6,000 or $7,000. So they're losing half of the benefit of those deductions and a large benefit of owning a home. So from that perspective, if we were to get a higher cap, then we would see more people benefiting tax-wise from homeownership. And that will, over time, impact homeownership rates, and it will allow more people to own homes than they otherwise would. The important thing to remember there, Jeb, is that it's only a piece of that puzzle, because we also had large increases to the standard deduction. And if anything, through this next process, those may grow a little bit larger. So what does that mean? It just means that if you have, in that hypothetical example we just had, there's $20,000 of state and local income taxes that you could deduct. Well, a married couple is getting close to $30,000 of a standard deduction. So if you didn't have almost another $10,000 of deductions, you're just going to take the standard deduction versus itemizing, which means no additional tax benefit of owning a home versus renting. So it would be high income earners, people in high cost states where we have entry level buyers buying $800,000 homes. Those people are going to have, in an uncapped state, in an uncapped regime for taxes, they're going to have enough property taxes, enough state income tax that it absolutely is a benefit to own versus renting.
So with that, so if there's a change in the tax benefits that benefits homeowners, let me back up and ask this question. Do you think there's people that don't own a house, don't buy a house because they don't see the tax benefits? Or is it truly the other pieces of the puzzle that, hey, the affordability is not there, I can't qualify, maybe I can't find the right house, all of those things, and then the tax piece is just an added bonus if and when it makes sense, or if they meet the deductions or what have you?
What's funny is we just talked about who would it benefit. It would benefit people in high housing cost, high income tax states. Those people, to me, that's not who I have the conversations with. I'm fortunate enough that we deal with people all around the country. So in a given month, I talk to 80, 100 different sets of borrowers. Where it comes up, where this issue comes up, is the people that are in a state that they're buying a $350,000 home. They tell me, well, we're married. Our standard deduction is so far beyond this that there's really no benefit of owning versus renting from a tax standpoint. They're not saying there's no benefits. They wouldn't be talking to me if they didn't have an idea that they wanted to buy and there were benefits. But we used to talk about it being a four-legged stool, or four major benefits of homeownership. And those tax deductions, the tax benefits were one of them. But the cap on state and local income taxes and the massive expansion of the standard deduction, especially for married couples, means that most people in the country don't have much tax benefit of owning versus renting.
All right, now let's go into the next piece here, deregulation. Josh, what are we talking about when we talk about deregulation with, presidential policies or that sort of thing?
So slightly above our pay grade, Jeb, but in doing research and reading this, a lot of the banking regulations, the reserve requirements for banks has made lending tighter than it otherwise would be. So those are fairly easy to impact without having to go through Congress. It's more of who are you appointing to the FHFA, the CFPB? What are the requirements there? So it should loosen lending a little bit in terms of deregulation. So there's like two pieces here. How does it impact banking? Because that impacts your borrowing and your interest rates and your costs there. But probably more likely over time, not immediately tomorrow, not even in January when he takes office, if they're able to do what they talk about or have indicated they would like to do. What you and I have talked about repeatedly here on the show is in California, it costs almost $100,000 to break ground. So if someone gives you a piece of land, it's almost $100,000 in planning, permitting, and entitlements before you can put a shovel in the ground. That makes housing much more expensive than it needs to be. Now, is some planning and permitting needed? And we don't want to live in a world where anyone can do whatever they want, build whatever they want, wherever. But maybe that number needs to be 40,000 or 60,000. And that would make a huge difference, especially in parts of California like the Central Valley, where we have more affordable housing, where they're building $400,000 homes and people would like and be willing to live. But if that's a $360,000 home instead of a $400,000 or $420,000 home, it would make a big impact. So one thing, Jeb, that I wanted to talk about in the context of this show is remember the timeline of all of these things. So whatever all of the proposed policies and campaign promises that were made, they can't all be pursued on January, whatever, when the inauguration is. So let's say it takes 6 months, 12 months, 18 months for that legislation to pass. Before it takes any impact, it's another 6, 12, 18 months. we're talking 2 to 3 years out before anything. If Trump was magic and had the perfect plan, I think it would be 24 months before you would see any change along these lines. And it is an area, we talk about divisiveness in the country. It is an area that is somewhat bipartisan. Democrats have typically favored more regulation, but housing is a hot button issue for everyone, right? Democrats and their constituents want affordable housing. And you can look at, it's not hard to look at $100,000 for planning and permitting and go, we could probably shave something off there and make this a little bit cheaper. So I think there's a very good chance that something happens there. It's just a question of the timeline, especially if you're watching this and saying, I'm interested in buying a house now in October, November, December of 2024.
Yeah. And I still, I mean, devil's advocate here, looking at it going, even if regulation costs come down, right? Even if the cost to build goes down, rather, if a builder is able to profit from building more expensive homes, does the builder still go for the more expensive piece of property, right? Are they still trying to maximize their cost? And the answer is always. They're always going to try to maximize. They're for profit. They are not for the people typically. And unfortunately, right? Builders are there to make money. So if it's less cost to build, are they passing that along to the consumer by less expensive real estate, or are the prices what the prices are because that's what they're selling for in a market? So I don't want to get caught up here and say that it's not going to do anything, because I do think it helps. I mean, you've heard this stat. I heard it again yesterday that the city of Dallas built more houses last year in 2023 than the entire state of California. California's got 40 million people. That's crazy to me that they can build that many homes versus an entire state. But the reality is less regulation, more land. They definitely have a different landscape completely than the state of California. So it allows some of these things to pass. But I also sit back and go, how much would it require for this to really have an impact in California? Now, other states, probably it does allow some less expensive homes to be built, but we're somewhat jaded here in where we live, Josh, and with the cost of real estate, does it actually help?
And you said something important there. Both candidates promised to open up federal lands to development. How much federal land is located near? I mean, we've got plenty of land. If you've ever gone a road trip across the United States, most of it you're driving through the middle of nowhere.
Sure.
Cool. There's a really cheap piece of land, but how do I get to a job? How do I get to a grocery store? How do I get to the gym? How do my kids get to school? So I don't know. They both were in favor of it. I don't think they would both propose it if it was insanity, like there was no federal land near urban centers or suburban centers where people could have jobs and amenities. So that could have some impact where we make more available land, a little less regulation. Builders, look at it this way, Jeb, to move houses over the last couple of years, builders have been offering huge incentives on the financing side. If $20,000 of lower permitting costs allows them to not have to buy your rate down because they have a $20,000 lower purchase price, it could get passed through. I'm not so jaded to say that they're just going to take all of it, because it is market based, and they have been having to find market based solutions to increase affordability. If they were given a gift of $20,000 or $25,000 in lower prices, they may not have to do that and still be able to hit higher profitability levels.
No, good point. Impact on lending. How does the change in presidency potentially impact lending? We've talked a little bit about the idea of deregulation and that sort of thing. But when it comes to lending, changes in FHFA director, does that impact lending, or are we talking about something entirely different here?
The CFPB and the FHFA are the two big ones. So what I would say is over the last 4 years under the Biden administration, there has been a huge use of the FHFA and the CFPB for social justice purposes. The best example that I have right now is they have made a big push in appraisal equality. So there's been a number of studies that say that homes in minority communities appraise for less than white communities, without a huge attempt to explain those discrepancies in any way other than race. So could there be is there something there worth exploring and seeing if we can make a more colorblind system for that? Absolutely. But the best example I have is Rocket Mortgage right now is getting sued by DOJ or CFPB over a single appraisal. One appraisal that said there was bias. They're the second largest lender, the biggest retail lender in the United States. They do hundreds of thousands of loans a year. And as post 2008, we have the appraisal independence requirements. A lender is not able to push back on an appraiser. Remember, that's undue influence.
Yeah.
You could give me the worst appraisal ever. I mean, other than if you put a Klan symbol on the front page of the report, I don't know as a lender what I'm allowed to do. We are not allowed to push back. It's an appraisal independence requirement. If they have the license, I mean, we could report them. We could make a report to them against their board if we feel like that's happening. And maybe that is the CFPB's point. But what I'm saying is they didn't find that there was a pattern across those hundreds of thousands of people of having discriminatory appraisals. They found one appraisal. So from that standpoint, I can guarantee you that we will not see that under the appointees under Trump. So from that perspective, what are the things that we're likely to see? What they have wanted to pursue the whole 4 years of his initial presidency. And one of the things he has his biggest regret is they did not return Fannie Mae and Freddie Mac to private status. They are government entities. They're controlled by the government. They're under conservatorship. So they have always had a quasi-government guarantee, an implied government guarantee, which we saw during the great financial crisis. They would have been toast. The government came in and bailed them out, just like they bailed out the auto industry, $187 billion. What's been lost is that you reaped huge dividends over the last 15 years because they've made massive profits that are swept away by the government, and politicians have taken that money and used it to fund other things completely unrelated to housing. So from that perspective, they want to privatize it. Now, there was a report done in 2015 prior to him taking office that said if we privatize Fannie and Freddie and there is no government guarantee implied or otherwise, that rates would go up 0.47 to 0.97%. That's a lot. I mean, if we're sitting here that a month ago rates were just hovering barely over 6, right now they're barely over 7, you're talking 7.5% to 8% interest rates. That would be problematic. It would push many, many more people to true government programs like FHA, VA, and USDA. So I've seen smart people on both sides of it say those numbers are overblown. There's no reason why we wouldn't be able to return them to being public companies, just like the auto companies. They didn't have to go into conservatorship. The government doesn't own GM. GM's back making cars. They got to bail out, and they proceeded as they always have. So from that perspective, there is some risk to higher interest rates if that were to happen, but they really wanted to accomplish this in Trump's first administration and didn't get it done, not because they didn't want to, because it's really difficult. It's really tough politically.
Well, let's talk about the LLPAs that were added on, Josh, because that's a piece of that puzzle that were added on during the Biden administration, that this idea that, hey, we're going to charge well-qualified buyers a little bit higher rate by some of these other things in financing, so that it makes it the cost for those that don't have as good of a credit score less expensive. So part of that social injustice type of thinking. Will that go away? Is there this mindset that the people that have done well, good credit scores, that they need to continue to offset the cost for those that don't have it quite as good?
I would say with almost near certainty that within the first 18 months of a Trump presidency, we will go back to what we've had for time immemorial. Whenever Fannie Mae came into existence 45, 50, 60 years ago, those loan level price adjustments are risk-based. They don't have anything to do with white, black, brown, green, male, female, young, old, buying an expensive home, buying a cheap home. If you're going to borrow from us, we have done a measure of the risk. If you put less down, that's more risk to us. If you have a lower credit score, that's more risk to us. Under the current administration, what they did, and this was twisted, everything's been politicized. The headline said they're taxing well-qualified borrowers to subsidize poorly qualified borrowers, which is accurate. But what it was twisted to is you're going to pay more for your loan so that they pay less. When in reality, a lot of the loan level price adjustments decreased across the board. It was weird. We did a whole episode on this, Jeb, and if you look at it, it was the middle of that loan level price adjustment matrix, sort of mid credit scores, 700 to 740, and 5 to 15% down is really where it got worse. So the only people that really benefited is those with low down and bad credit had much lower loan level price adjustments. And there is zero justification for that, because we're talking about potentially privatizing, returning to private status Fannie and Freddie, which means any business has to price for risk. You don't get to price for outcomes. So because the government has them in conservatorship, they can say, you're going to do this. Mm-hmm. If they're private, then we are going to have a normal set of loan level price adjustments that reflects the risk that you present to a lender, not, don't get me wrong. There's nothing that says people of color pay less than white people, that women pay less than men. But what it does is they improve the terms for people with lower down and lower credit scores, which again, those are the two primary drivers of risk to a lender. So why would we make those cheaper? And it wasn't directly offset by the more well-qualified borrower. So it wasn't a one-for-one offset. You increased risk to the system when you're saying in a perfect world, we would privatize these companies. They'd be responsible for themselves so that the government doesn't have to do a bailout. So the simple answer to your question is, I would be shocked if 2 years from now we're looking at the same LLPAs. It would probably go back more to what we saw prior to that. And it's probably due, risks change over time, data changes over time, analysis changes over time. It would be probably appropriate that you revisit it from time to time and change those loan level price adjustments to more accurately reflect the risk to the system.
Which in turn could offset some of those rising rates if and when they do go privatized, and that there is some offset that you mentioned a moment ago. So let's talk about immigration, Josh. This is a big topic. How does it impact housing? Does it impact housing on the demand side? Right? There's this idea that by deportation, taking illegal immigrants and having them leave the country, that in turn would create less demand for housing, which would allow supply to grow, and just less competition out there in the market, making it better for homeowners or potential home buyers here in the United States. Do you see it that way? And secondly, we've talked about how it impacts construction and that sort of thing. So let's talk about that side of it as well.
It makes sense that we have a finite amount of housing in the U.S., both for ownership and for rental. So if you add 10 million people to the population in 4 years, we now have an even worse supply-demand imbalance. But again, we're the educated home buyer. We are talking to you because you want to buy a home. Let's say that you are in Indianapolis, Indiana, and you're looking to buy a $375,000 house. If someone made the long trek up from Central America with their family, illegally immigrated, or came through the border and was released into the U.S. to come back in 3 or 4 years to find out if their asylum claim is legit, they don't have citizenship status. They can't qualify for Fannie, Freddie, FHA loans. They're probably going to have a hard time getting a job. They're just brand new here in the country. You know, for you as a U.S. citizen who grew up here your entire life, that it is not easy to get a job, make money, manage your credit, qualify for a mortgage. I don't think any of these people are buying homes. These are not, we talk about like the H-1B visa program, where the U.S. imports people who have skills that are needed for U.S. industry that we don't have enough of. Those people come in, they make good money, and they're here legally, so they have a resident card that allows them to buy homes. Those people are competing against you for homes. The illegal immigrants that were the major issue here in this election are not competing against you. They can exacerbate the rental issue. They have to live somewhere, right? So it could be driving up rental costs in markets where large concentrations of them have relocated. But I don't think on the for purchase market, it's making a huge difference. So if it didn't make a difference on the way in terms of driving up costs, making it harder to get a home, if they were all deported, if you could wave a magic wand and they all went back to the countries that they came from, it doesn't really change anything. So I think this is a non-issue for the housing market. Big issue for the country, non-issue for the housing market, at least for those of you looking and wanting to buy.
But let's talk about the other side of it. Construction, building of houses, right? A large, I don't know what the numbers are, so I'm not going to sit here and quote it, but I would say that there's a decent percentage of workers out there in the industry on the construction side and the building side that are probably illegal immigrants to some degree. It's typically cheaper labor, usually hard workers. I mean, it comes with some benefit to those that are building homes. If you deported illegal immigrants, the cost to build could in theory go up, right? I mean, that is reality, which would in turn make housing more expensive. So it could have an adverse effect on prices by deportation, at least to some degree, especially in areas that are highly concentrated with new construction. Southern California, you don't have a lot of new construction. Areas like Texas, Arizona, Nevada, some of these that are booming areas with tons and tons of new construction could be impacted the most.
Most of the construction in the U.S. and almost all of it in California is done by big national builders. It is illegal to employ people who don't have legal residency status and authorization to work. So again, I don't know how many of these people, could you be a skilled builder and come from South America? Absolutely. A framer, an electrician, a plumber, whatever. We have different regulation here. So again, I don't know how many of those people are really filling those jobs, but it would be naive to think they're not filling any of them. Where I think you would see more of an impact is not the big nationwide builders, but contractors, subcontractors on the local level. Could I believe that the guy who contracted to redo your $40,000 kitchen at your house has a couple people that are undocumented on his staff and he pays them cash? Absolutely. So anytime you reduce the supply of something, the cost of it goes up. And there is no doubt that many of these folks who came here in the last 4 years do not have legal residency status, do have skills and work in industries that we value. So the cost would likely go up. I don't see how you could show that as a positive, making costs for home building, home renovations going down. It would be neutral to negative at best.
All right, so let's take that same sort of conversation and throw it into infrastructure. So no longer just talking about housing, but infrastructure in general. Is there an impact in that regard?
Again, construction jobs and we always talk about this. So under Biden, the last piece of legislation that was passed through COVID was the Inflation Reduction Act. We're going to spend a bunch of money to reduce inflation, but a lot of that was earmarked for infrastructure. So that money is out there. I don't understand or know the process. Maybe it could be done away with, not spent, but it's likely to get moved.
Fat chance, bro. If it's signed for, it's allocated somewhere.
So from that standpoint, we have seen that even though construction is down, construction jobs, we haven't seen one of the bellwethers when we're looking at the unemployment reports is the canary in the coal mine is generally construction jobs. When construction unemployment starts spiking, you go, oh, okay, the economy's not doing well. Things are coming behind it. We haven't seen that despite residential construction being down over the last couple of years, because of some of these other jobs. They've shifted to construction, roads, government buildings, things of that sort. So it should put a floor under some of the employment issues that we have, or potential concerns for rising unemployment going forward, which again, we've talked about what is one of the things that will be an indicator that lower rates are likely ahead would be an increase in the unemployment rate. So the fact that you have the government sort of backfilling some of this demand for labor that otherwise wouldn't be there, maybe we get a distortion there where you don't have employment break and therefore you don't see rates drop as low as they otherwise would. Mm-hmm. So from this perspective, I think you're going to see wages held higher, unemployment lower. So good for people as a whole, but not good for interest rates and affordability. So a lot of these things, you look at them, you take them in isolation, you go, I voted for that person because they're going to do this, and that's good. It's good, but there are unintended consequences that come along with it, and you got to balance everything out in total.
Well, let's talk about that because that's an important piece, Josh. We do know that Trump is pro-business. He's pro-growth. He wants the economy doing well. He wants jobs created here in America.
He wants low interest rates,
and he wants low interest rates at the same time. Those things offset each other. That's very difficult to do. To have growing the economy, jobs coming to America. More money circulating in the system because, for one, that creates inflation. But at the same time, we do know that the Fed at the moment has their thumb on the Fed funds rate, saying that, hey, listen, we're going to continue to cut as the economy slows down. What if the economy doesn't slow down, Josh? What if he comes in January and gets off to a gangbuster start, employment gets under control, unemployment goes down, more jobs are created, and stock market continues to go gangbusters. People pull money out of bonds. These things offset. These things are will adversely affect interest rates in a negative, like rates will go higher. What does that mean? Like, I know there's a lot of uncertainty, a lot of things we can't answer, but these are the things that people aren't talking about because, one, they don't really know, but it's the idea that, hey, we elected Trump because we thought all of these things were going to happen for us. We want it all. And the reality is you can't have it all.
We talked about 100%, and we talked about on the live show last night a bunch of this. That why is the Fed cutting, and why is the Fed cutting not leading to lower mortgage rates? The Fed is cutting because they have room to cut. They have been restrictive, and they remained more restrictive than necessary for a long period of time. We haven't seen any negative repercussions. The economy hasn't slowed down. We haven't hit a recession. So with that, they are trying to take away that sort of excess restraint before it's too late. That doesn't mean that they're going to go and somehow become really accommodative and take rates low, where it's going to push economic activity greater, higher GDP, more housing purchases, more auto purchases, things of that sort. So what we've seen since that meeting where they put out their dot plots that they were going to cut 75 basis points more this year and 125 next year. So 200 basis points in total. And we've seen about half of that taken away from the Fed funds futures market. At that time, the Fed funds futures market was saying even more aggressive than what the Fed had quoted. Right now, we're seeing about half of that. And the reason being is exactly what you said. This Trump trade, basically the playbook that was implemented by investors, investment houses, investment advisors back in 2016, they're like, hey, we have Trump again. Let's follow that same playbook. But there's some pretty big differences. When Trump took office in 2016, the 10-year treasury was at 1.8. As of today, we're hovering 4.4. Might be a hair under it or hair over it right now. It's a pretty big difference, right? 2.6% higher than where we were at. So we have, by almost every measure, there were some nice tailwinds behind the stock market at that point in time versus we're at really high levels. So in terms of almost every measure, price to earnings ratio, whatever your preferred measure is, almost all of them are at nosebleed levels, near all-time highs. So it would tell you that we don't have those same tailwinds. It doesn't mean that stocks can't continue to do better, but it's going to tell you it's not going to be as easy as last time. So just rolling out that same playbook from 2016 is not quite as simple or quite as easy. So if you look at that, at that point in time, in 2016, with 1.8, we had inflation just over 2% and a 1.8 10-year treasury. So if you invested in 10-year treasuries, you were expecting to lose money over that 10 years because you had a negative real return. So who would invest in treasuries? You'd say, this is dumb. I'm going to take my money out of treasuries. I'm going to put it in the stock market. And at that time, stocks did really well. Bonds did really poor. So right now, we're looking at an issue where are people going to pull money out of bonds that are at 4.4 when we've got a 2.5% inflation rate? So almost 2% real return there to put it into a stock market that could absolutely go higher, but it doesn't have that room to run that we saw in 2016. So you're going to get that knee-jerk reaction. We're going to see that. But it's not the same environment. So expecting the same outcome as last time would be a little bit crazy.
And then there's another thing, trade policy, right? We do know that he's big on tariffs and that sort of thing, which at the end of the day doesn't directly go into housing until you start talking about construction, importing. Like we get a lot of construction material from overseas, believe it or not, drywall. I mean, a lot of different things. And so that coming into the United States, we pay the tariffs as they come in, which and that cost gets passed on to the consumer. So these things do have, I mean, yes, they have a benefit for America as a whole, but it also has a negative impact for those looking to buy houses. So at the moment, what I can say, Josh, is there's a lot of unknowns. We don't truly know what is going to happen. We have an idea of who Trump is as a person, as a business owner, as someone that's led the country previously for 4 years. But as you mentioned, things are different now. We have inflation. We have, we had a slowing economy. We have a stock market, valuation that is much higher, trading at levels that we've never seen. All of those things are going to impact the decision-making process, which in turn could have an impact on you as a potential home buyer. So, Josh, if you were somebody out there at the moment, thinking of buying a house, there were people waiting. They were waiting to find out who the president was. I'm going to wait to see who the president is before I buy a house. Should there be any more waiting? Is there a reason to wait, continue to wait? Is there a reason to buy now, or is it status quo? Is it what we always talk about?
Well, what have we always said? Buy when it's the right time in your life and you are able to afford a home that meets your needs. You have good credit. You have some savings. You're stable in your relationship. You're stable in your job. You're stable in where you want to be for the next 5 to 10 years. If all those things are true, you have more certainty than you had on Monday. Truly, you and I talked even midday Tuesday. What's going to happen? Like what in 12 hours, in 2 weeks, who you didn't know. So now we have certainty on almost everything except for Congress. We know who Trump is. We know what he wants to do. We know what the potential outcomes are if he were to achieve those things, but they pale in comparison to you and your situation. If it's the right time for you to buy, then pursue it, knowing as much as you can about this, and also knowing that there's a lot of uncertainty, despite the fact that we know who's going to be in office and what his proposals and priorities are.
Yeah, I mean, as real estate is local, so are politics, right? Politics, what happens locally with politicians is going to impact you, probably have a bigger impact on what's happening in your housing market than what the president is doing, right? With regulation, with everything else. So pay attention to what's happening around you, be informed, find people that you can trust, stay educated, focus on the things you can control, your credit score, your down payment, your budget, right? Start with the budget. Find somebody you can trust. And if you don't have that person, reach out to Josh and I. We have a team here that would love to guide you through the process. Maybe you're already in the process. Let us be a second option for you. Let us look at it and just, help you decide whether or not that's the right program for you. And if you haven't started and you're ready to get started, reach out. We would love to be that option for you as well. But with that said, guys, until next time, make sure you buy right, borrow smart, build wealth. Adios.
Amigos.